Hello everyone, hi, welcome to the channel of Wall Street Mojo. Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon. Friends, today we're going to learn a concept which is known as matching principle of accounting. This is a part of the policies in the accounting policies and the framework. Let's understand this. There's a box given over here. Let's see what is written here, and then we can interpret. And at the same time, we'll do the explanation portion. Matching principle means that you should record the expenses in the income statement in the same period by matching it with the corresponding revenue. So the expense and the revenue should be recorded the same period. Now, what is the matching principle? Now, the matching principle basically means that you should record the expenses. You should record the expenses in the income statement in the same period by matching it with the corresponding revenue. Now, this means that the expenses which are entered into the debit side, of the accounts should have the corresponding credit entry, right? This should be there, right? Now, this means that the expenses which are, if in the double entry bookkeeping system, this debit and credit entry should have a complete match and in the same period, irrespective of when the actual transaction is made. Similar is the case, with the which which when entered into the credit side of the accounts should have a corresponding debit entry. It should have corresponding debit entry during the same period, irrespective of when the income is actually going to be received. The matching principle example. Let's take one example. The first and the foremost example that we'll take is the accrued expenses. Let's say for some work you hired a contract laborers and you agree to pay them $1,000. Okay, the work is done is the month is in the month of July. However, the laborers are paid in the month of August. So what is exactly the cost accounted for in the July? Now, what we need to note here in the matching principle of accounting, for expenses, the actual date, you can say the actual date of the payment does not matter. So it is important to note when the work was exactly done. So in this case study, the work was completed in the month of July. So this recording of such accrued expenses, irrespective of the actual payment made or not, and matching it with the relative revenue is known as the matching principle of accounting, right? This is the first example. The second example that we are going to understand is the interest expenses. Let's understand the second one. Let's say that you borrow an amount equal to $1 lakh. How much are you borrowing? $1 lakh from the bank to start your business. And what do you realize? The annual interest you are supposed to pay over there is, let's say, 5%. The payment of the interest over here is, let's say, done at the end of the year in December. Let's say you pay at the end of the year in December. Now, what is the interest expense accounted for in the month of July? So you will have to pay the total interest over here equal to your 1 lakh, which is the amount, into 5%. That is, total comes down to 5,000. So you need to match the interest expense to each of the monthly revenue. Now, the interest expense to be recorded for the first 1 month, July, is going to be is equal to 5,000 divided by 12 months. That is 416.67. Now, let's take third example of depreciation expenses. Let's say on July 1, let's assume that you buy a machinery that is worth of $30,000 and its useful life is, let's say, 5 years. So how will you record the expense for the transaction in the month of July? See, the reported amount on the balance sheet for the assets as equipment, vehicle and building are routinely reduced by depreciation, and the depreciation expenses is required by the basic accounting principle that is known as the matching principle of accounting. So Depreciation is used for the assets whose life is not indefinite. Equipments wear out, vehicle becoming too old and costly to maintain, building age, and some assets like computers becoming obsolete. So for recording the depreciation expense as the matching principles of the accounting, you can calculate the yearly depreciation, that is by a straight line method, that is the SLM method of accounting. So what you can do, you can just record it as 30,000 divide by 5, which gives you 6,000 per year. So with this depreciation expense charge for the month of July is going to be 6,000 divided by 12. That goes down to 500. So this was some of the examples of accrued expense, interest expense, depreciation expense. Now let's understand the matching principle of accounting, the comprehensive example. Consider, there's a company called 𝐏𝐜𝐜𝐲. They have started with the window washing service business on December 18th, let's say, and by investing its own equity, so we can see the equity around $10,000. He has bought, let's say, tools required for the business that are worth $3,000, worth $3,000 on December 20th. John, or let's say a KG, hired two helpers who are directly employed by the company at the rate of 4,000 at 4,000 person per month, right? This is done on December 21st. And he received a contract of window washing on December 22 to be performed on December 23, right? For which the client paid him 500 on December 22, and would pay him remaining 2,000 on December 27th, let's say not on 23rd but on December 27th. These are some of the details after the end of the festives. And he received another contract on, let's say, another contract on December 27 to be 23 carried out on, it should be carried out on Jan 5 for the client, which client paid him 1,500 in advance. It's not allowing us to do, let's say, 1,500 in advance over here. And he paid salaries to two helpers of $8,000 in total on Jan 2nd, as the company pays the workers after the end of the period. So we can prepare the journal entries as on December 31st for the whole example that we have quoted here. See over here, the December 18 cash accounting to shareholders equity, which you pitched in, tools which you purchased, the cash account, the cash amount that you received, the account receivable, and the revenue and the unearned service revenue, which was 502,000. The the cash account to unearned service revenue related to the 1,500 amount, this, and the cash account to the receivables, which is still outstanding. The last, that was a salary on the 31st December, right? 8,000 to the wages payable, 8,000 which was not been paid. And the last entry in the above example was the wages payable to the cash, that is to the extent of 8,000. So the final thoughts on this can be discussed as the matching principle of the accounting system is which follows a dual entry of bookkeeping system has to strictly be followed the matching principle in accounting. So using the matching principle in accounting, the accounting system gives a very closure look or a picture of the mainly of the current assets and the current liability of the company, which helps the investor and other financial analysts to understand the worth of the company and how well it's being operated with the help of the quite some ratios. So the company performance is determined, which helps the investor to take decisions for the investments. I hope you have got a great insight. Thank you, everyone. Cheers. So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.